Now, recently, the Confederation for British Industry, or the CBI, has warned that the UK economy is not only heading for, but is facing the worst of all worlds. Now, this is likely to include, but not be limited to, a stagnant or even a negative growth in the economy, rising inflation, higher mortgage rates for longer than expected, businesses shutting down, rising unemployment, and all that's going to result in excessive stock market falls due to lower company profits. Hi, my name is Simon and I'm a chartered financial planner, and it's been an absolute privilege to have helped hundreds of clients as well as their families get far better financial outcomes over the last 30 plus years. So in this video, I'm going to look at the distress signals that are flashing red in the economy and why we should not only expect a recession in 2025, but why we should all prepare for a recession in 2025 so that all our financial plans can remain on track. So welcome back to the Personal Finance Crew, and if this is your first time, a very warm welcome to the Economies channel, where together we're going to be learning the language of money and wealth. So let's go back to the studio together, and then we can identify the economic alarm bells and take the appropriate action where necessary. So I'm going to see you all in a minute. So the government has taken a wrecking ball to the economy, and to put this into perspective and into some context as well, I'm going to look at the multiple factors which indicate that we're already teetering on the brink of a recession in 2025. So I'm going to look at the following signals. The UK 10-year gilt, and that represents the cost of borrowing money for the government. The Bank of England forecast for no growth in the fourth quarter in 2024, and how we've gone from the fastest growth in the G7 to the slowest. We're going to look at some inflation measures, credit card defaults and the rates of interest on credit cards, stock market performance in December 2024, both here and in the US, government spending, some high street closures, and of course that's resulting in rising unemployment. So by understanding these warning sounds, we can all take action if necessary. So at the time of writing, the UK 10-year gilt is 4.62%. And as you can see in this chart on screen, that has increased strongly due to the uncertainty that's been caused by the budget that was announced on the 30th of October 2024. Now, the 10-year gilt is a reflection of the cost of government borrowing, and that is what is to be paid to investors who lend the government money. Now, a higher yield means that there is less confidence in the UK economy, and as a result, those investors are going to want a higher interest to compensate them for taking more risk. This also means that those with mortgages who have to remortgage in the near future are going to have to accept higher mortgage rates for longer. This also means that we're all going to have less money to spend and the economy will slow down yet further. So I'm going to put up several recent financial articles on screen, and that is going to try and explain that the recent £40 billion government tax grab, incredibly, may not be enough to stimulate economic growth, and how we may all end up paying more in taxes and sooner than we think. Now, I really do hope that the government is not just crossing its fingers and hoping for the best with our money, but if I could offer my humble advice to Rachel Reeves, and that would be that you cannot tax your way to grow the economy or to have a healthy economy. So the Bank of England, in their most recent forecast, now expect zero growth to the end of December 2024. And the overall growth for the UK has been downgraded since the budget by multiple UK as well as international agencies. So this means that the UK has gone from having the fastest growth in the G7 to the slowest growth in the G7 in about 6 months, and that's got to be some sort of a record. So another red flag is that we now have again rising inflation, and that's just after the government finished their victory dance and confirmed that inflation had been put back into its box and was finally under control. Now, the official inflation number has increased to 2.6%, which is still low by historical standards, but it's been stubborn for a long time now. When you add housing costs into this as well, the inflation rate is nearer to 3.5%. In fact, core CPI with food costs and energy costs stripped out is also 3.5%. And this is why the Bank of England has decided to keep the bank rate unchanged at 4.75% at their most recent meeting, and that's to try to get inflation to their target of 2%. Now, I understand that many people do need to use credit cards for many reasons, and they can be very positive, especially if they're used correctly for travel points or discounts or club points, and any balances are paid off in full every month. But there's been a recent disturbing and a distinct rise in credit card balances as people are using credit cards to withdraw cash just to make ends meet at the end of the month, and even more are struggling to make the minimum payments as well. So if the average credit card charges over 20% in interest per year and you make the minimum balance payment each month, it's going to take you up to 13 years to clear the balance. Just let that sink in for a minute. So far, we've looked at the following signals. There's less confidence in the UK, leading to higher government borrowing. There is no growth projected to the end of December 2024. We've got confirmed rising inflation. We've got rising credit card balances as well as defaults. And we've also now got the slowest growth in the G7. So if you're finding value in this video, then please give it a like and subscribe to the channel as we continue to work hard every single week to build this financial planning community to over 10,000 in 2025. And you can also hit the notification bell so you won't miss any content which is published on a Saturday at 5 o'clock in the afternoon. And next week's video is going to be interesting. So it's going to be a celebration of our first year anniversary. And that's going to include a lot of the bloopers that we can publish. But believe me, there was a lot of bloopers that we could not publish in case we breached the YouTube decency rules. Now, I've heard a lot about how the magical technology companies and AI is going to revolutionize our way of life, and that's very true. But these companies also need the right economic conditions to thrive. And in the US, the Federal Reserve indicated that they are only going to be lowering interest rates twice in 2025 instead of the predicted 4 times. And then the stock market fell very heavily as a result of hearing this news. Now, over here in the UK, we all know that when the US sneezes, we all get a cold. In fact, the US stock market had 10 consecutive daily declines, worth about 6% of the market value. And this was the most consecutive declines in 50 years. So sure, the financial markets are up very, very strongly in 2024, as they were in 2023 as well. But this is a signal that valuations are extended and are stretched. And it's likely that many companies are not going to be able to generate the sales and the profits needed to justify these sky-high valuations and share prices. And that all means more uncertainty and more volatility throughout 2025. So moving back to the UK, the budget in October was a tax, borrow and spend budget, the likes that the UK has not seen since 1993. And we've now had the worst tax burden since 1949. That's 75 years and the worst in post-war Britain. So as you can see on this chart, the fear is that the lack of discipline with government spending is going to lead to yet more borrowing. And this spending on things might not directly improve our lives, but are likely to spend on causes outside of the UK. Even more than that, it could be spent on vanity projects that are unlikely to stimulate growth. And that's going to mean more red tape, slower and more ineffective decision making. Now, if you add all this up, the outlook for business is not positive. In fact, business confidence is now the lowest it's been for 2 years. It's also very worrying to see that the UK is at or has possibly breached the 100% debt to GDP level. So according to the ONS, the monthly repayments in October 2024 for UK debt repayment was a staggering £9.1 billion. Now the OBR projects that this might be slightly lower at £7.5 billion a month, but that will depend on the 10-year gilt yields as we talked about earlier in the video. So let's just call it an even £100 billion a year just to pay our debts. £100 billion a year. Let that sink in. Now, when we look at business confidence, we look at the Lloyds Bank Business Barometer, the BDO Optimism Index, and the ONS Business Insights Index. All these are citing lower business confidence due to rising costs, changes to retail spending, falling orders, and uncertainty about future government policy. Now, it's clear that our trajectory has changed direction and we are now bumbling along at the bottom of the G7. And that's compared to an invigorated USA promising less financial regulation, cutting government wasted spending and focusing on an America first in their policy decisions. Now, all this negativity has got real world consequences, as there were 170,000 retail jobs lost last year. And to put that figure into context, that was the largest set of losses since the lockdown in 2020. And there's a projected 200,000 more jobs expected to be lost in 2025. For example, you might remember Lloyd's Pharmacy, Home Base, The Body Shop, all closed down. Now, to confirm this negative outlook, Joshua Banfield from the IFS has said job losses this year in 2025 could eclipse those even at the height of the pandemic. So let's just have a look at the Bank of England unemployment projection chart. And if you look at this fan chart and focus on the darker purple section from 2024 out to 2027, you'll see unemployment rising from around 4% to as high as 5.5% at the end of 2027. Now, just to put that into context, let's say there are about 35 million people employed in the UK. That means there's another 500,000 people losing their jobs, and that means they are not supporting the economy. So, are we entering a time of stagflation, which is reminiscent of the 70s and when we had a mix of higher inflation, stagnant growth, and higher unemployment? Well, time will tell. So if we do get a recession in 2025, here are the 7 things that you need to do to make sure your financial plans stay completely on track. So number 1, make sure that you are diversified across asset classes such as stocks and shares, bonds, commercial property, alternatives, and cash. And make sure you're going to be invested across companies, sectors, and countries. So number 2, you need to have a suitable emergency fund in place so you're not tempted to sell your investments, especially when they're falling in value. So number 3, you need to automate your investing by setting up a monthly direct debit and use something called pound cost averaging throughout these volatile periods. Just keep buying. So number 4, focus on quality companies, as these tend to have the brand reputation and the funds to weather these financial storms. Number 5, consider more defensive companies which pay consistent dividends year after year, and you may be able to give up some potential growth, but this will be smoothed out by the total return you receive and the dividends on top. So number 6, remember to have a long-term mindset, as stock markets are forward thinking and they have always recovered in value. It just means that it might take a lot longer than you think, so be patient. Number 7, this is the big one. Control your emotions and don't have any knee-jerk reactions triggered by either fear or greed. So being aware of a recession in 2025 is really important, but there are other important lessons to learn, and I've linked 2 more videos in this series to understand whether you should spend your money or save it in retirement, and another video on the most efficient way to take money from your pension via drawdown. Thank you so much for watching to the very end, for your time and for your patience as always, and I'll see you for our special 1-year anniversary video next week.